Hey, what's going on, everybody? I'm doing here a real quick crash course on order flow. Order flow is a very broad term, especially when you look on YouTube gurus. They kind of show you a footprint chart and a couple of things on the dome. Oh, there's liquidity here. I'll go long, exit out liquidity. This is the profile, and breaks profile, I'll go long or short. So some very basic stuff. If you actually spend a lot of time trading the dome, you'll start to notice there's some things that happen in the dome that no one ever really talks about. I think Axios is probably the closest I've seen that really kind of goes into detail, but they're not willing to divulge everything because, like SMB, all these other famous firms, they have their own educational process that they want to sell. And I guess you can't blame them. And maybe they have some in-house training that they don't really want showed to the public. So, but I'll be covering a few things. But the first thing I'm going to cover is the standard volume profile. This is something I like to use a lot. There are market profile traders that follow the Dalton theory, but it's whatever you want to basically think of it. But when you sit here and you see this this line here, this line here, and this line in the middle, we call this the value or low, value or high, value or low, and point of control. This within this range is what we call the fair value range. Everything in this middle. This is basically where most of the volume is conducted in the range of the day in the auction. And then this yellow line you see here is called the point of control. This is where most of the volume is conducted. Now, the thing is that it's not just, one single print of a range. As the day progresses and volume starts to spread through the auction itself, or the rotation, whatever you want to call it, the range could change. But usually after about 2.5 hours, most of the trend is kind of implemented, the highs and the lows, and the volume profile is set. The one thing that can sporadically change is the point of control. Now, a lot of people will actually use each one of these lines. They'll actually use the delta. We'll show you every single price point, how much was conducted on the difference between the buy and the sells. Some people like that information. I personally don't care. The reason why is because I use the dome to see that kind of information in detail. But the thing is, people have to understand is the volume profile is very important, because if you actually watch the dome, you have a heat map. Whenever we dip into the value or low, point of control, or the value or high, algorithms are attached to it. All of a sudden you'll start to see a smooth price move to it, and once it hits it, all of a sudden you see is the heat map and all kinds of things. Prices just fluctuating like crazy at those levels, and humans cannot trade that fast, so obviously those are algorithms. So this is a very key thing to kind of measure as the day goes by as far as volume. It's a simple concept. Volume precedes price. As volume transacts, the price moves. It's not the opposite. The one thing I primarily use the profile and intraday is basically understanding. I kind of use them as targets. So for example, if for whatever reason the POC prints right at value area low, and I go long there, I'm using maybe the value or high as a target. And you can also use yesterday's POC and the range of yesterday, especially if they're printed inside each other, or if it's starting to push way upside and then the value area of the current session is below the yesterday session. So the value area low can be a target, the POC can be a target, and you'll start to see as time goes by, literally the market will go up to yesterday's point of control of value area low, and then it'll completely dump in reverse. Is that coincidence? I do not think so. So that's something you'll figure out as a trader as time goes by. This is kind of a little bit of example. So you had the print in this value area, market came back up, gapped up, hit basically the POC, yesterday's POC range, and dumped. So that's just kind of a little bit example. It's not always 100% every day something you count on, but it's something to add to your arsenal, and something that rhymes. It never repeats 100%, but it does rhyme. But another factor I like to do is when I start to see for example, if the market dumps, or let's say the market goes up and it pulls back and it starts to build balance in a range like this. If I have 3 days, 2 to 3 days of the volume profile printing in the same range, that tells me there's a lot of spent up energy in this area. And eventually it will break out to the downside or the top side, and it will move very aggressively either way, up or down. So that's what they like to see. I also like to use it as kind of like a stair step. So for example, if yesterday's value area's range is this way and the market's right above it and stair stepping up, that tells you it's kind of a bullish trend. What I also like to look for is Let's see if I can find a good example of one. So this is basically like two back-to value areas. POCs in close range. The highs and lows are very similar range. That's telling you that there's a lot of trade that's happening, and then it gapped completely up. This one's a pretty decent one here. So 4 days back to back, and then eventually it broke up to the top side. So that's kind of what I like to see is interesting. A lot of people will slowly just trade the volume profile range, and for example, they'll calling, for example, the following break, or whatever they want to call it. If it breaks below the value or low, or breaks above the value or high, it's extremely bullish. They'll wait for the breakout, test of it, and then go. Depending on how you want to trade it, I basically kind of use it just kind of see just how the day is going. And intraday, I've used them as targets, supports, resistance, maybe point of control. If the point of control moves around the value or low or high, that's when it's kind of telling me insight that's probably going to move off that level. It's being absorbed there. So that's kind of why I use the volume profile. Now my intraday ranges is going to be the orange line, which is the overnight high and low. And the green line is going to be yesterday's high and low. This is very important, especially when price opens up in these areas. There's a 90% chance it's going to fill one of these gaps. Sometimes it doesn't, but there's a statistical 90% probability that it will fill one of those gaps. I wouldn't say it doesn't happen, that it never does, but for the most part it does. So, for example, this right here, price opened up in the mid-range and it gapped right to the overnight high. But before it did, it had a good pullback and then moved straight through. That will give you a good entry. Overnight high up above here, eventually broke all the way down to the range. So these are gap fill trades that you can count on. And then one of the very big things I like to use is which is called the initial balance range. So when the market actually prints the first hour, that's what we call the IB range. And basically you have the IB low, IB high. And the reason why I bring these up is because there's a lot of situations where algorithms are attached to the initial balance. And usually during the IB is set, the price is usually in the middle somewhere and will gap fill to either the low or the high. But there's a lot of times where we'll hit the IB low, IB high, and we'll rotate it. Sometimes to the tick, sometimes you'll breach into it, the low, sometimes you'll breach into the high, and you can use the VWAP as targets. It's very simple. It's not too crazy to really think about, but it's not always, like I said, textbook. It's not going to happen every day. But a lot of the times what you'll see is it'll bounce off these ranges. Price will absorb around these lows and these highs, and you can use these as ranges to kind of levels that you can scalp. And sometimes you can use them as just general targets within themselves too. But yeah. So we're going to go into order flow, and why is order flow very important? Because when I talk about the reload failure and the reload follow through trades, it applies on every single general price action just in itself. So I'm going to give you guys a decent example. This was a NASDAQ a couple days ago. You had the IB that was set. The market came through. Actually, the IB wasn't even set at this time. But the market came through, hit it, and it hit a bunch of stops, and it completely dumped to the downside and filled the overnight low gap. Now, what's very interesting thing about this is what I like to use Bookmap is, I actually took a picture. Let me see if I can find it real quick. So this is right here. This is something I actually attempted to take a trade. A lot of the times I will be very successful on this trade, and sometimes it just doesn't work out. So what you're seeing right here is when the market came up and swept straight through this level, you start to see this big giant huge bubble, green bubble. Now this is showing you when the market came straight through, there was a lot of resting orders on the offer. So that was basically resting liquidity, absorbing the buyer. So you start to see this big giant green volume. It's much larger than any of the other volume candles here. So that's signifying that that's a massive push up. The delta itself right here is just showing a massive push up. But what's a very interesting thing is you can see this red dot here. This is telling me there's 552 stops that was triggered here. That is very key. When you look in the book itself, it's not very big, 50, 10, 16. You're seeing the transaction in the book itself right here, whether it's the buyers or the sellers, 200, 100, 120, and the spread differences in the delta 55, 45, This is 10 times larger than the average size. So if we get a big hit of 500 stops, it's 10 times the size. That's telling me that's going to be a move to the downside. Now what you're going to see is right here, these little arrows is basically I entered a short in these positions. I entered it twice. I got stopped out once. The second one was a fill, and I made some of my money back that I lost. But eventually the market started to push a little bit further back up. I started seeing buyers. I actually killed the trade. But what actually happened is if I would have took the second stop, the market completely dumped down. I think that was a $200 move, came back, and then just continued to dump completely down. So I could have added into that position. A lot of the times is I will be very successful in these trades, and these are the type of trades I like to look for. So when you sit here and you think about these trades, these highs and these lows, because when you think about it, just in general, there's a lot of traders say they buy in, lows and they sell the highs. But what they're failing to see is what order flow is going to tell them is when the price gets into this high, what's going on. A price can stall here. You can literally do this. And traders are betting it's going to dump. There's many occasions where the bids come through and they push it straight through. How can you see that? How can you game that? Well, there's a couple things you can really start to see is you could use the book. You could literally see real time if the bids are coming through, the offers coming through, or who's being absorbed there. That information is going to give you a better idea if you're going to go long or short there. So that's what's kind of interesting. And then the sideways price action is kind of telling you there's a battle, there's absorption gain done there. So by looking at price, you're actually, looking at the dome, looking at the footprint chart, whatever tool you decide to use, it will actually sit there and tell you who's actually winning the battle in that very moment. Now, we could say here and say that buyers are actually winning the battle, but once we break out of here and we hit stops, it may completely reverse and dump. That's why as an order flow trader, you have to be a scalp trader. You got to be basically take your few ticks, 20, 30 ticks NASDAQ, or your 1 or 2 points on ES. If you start to see something in the order flow change, you got to get out. I rather get out 150, 200 bucks and then basically let it reverse, reabsorb, then go back up again, because then that's going to offer you 2 trades versus that one guy that went short, put his stop above here and just took the full stop. Because if you sit here and look at a chart, you enter the trade, you're basically just, you're gambling at this point. But when you look at actual order flow itself, what's the price that's going on in that very moment, it's not just a guess. Now you're backing it by data. You're taking an educated guess, not just a blind guess. Now I'm going to sit here and kind of explain the book itself by ES Trade. Now if you're using Jigsaw, Trader, Sierra Chart, a lot of the popular retail platforms, you're going to have to forgive my book map because I don't use the dome heavily as much as other people, but it's, it is what it is. But so when you sit here and right here, you see this SVP. This is standard volume profile. So what you saw in my ninja chart right here, this is the volume profile. But this right here is explaining me how many orders were conducted on each one of these lines. So when you're seeing right here, start to see these little lines, these little blocks. Well, that information is provided to me on the dome. So I don't need to sit here and see a bunch of numbers on my chart here. Not only that, because I trade on Bookmap, when I enter my trades, I can see it right here. Now, the volume profile buy and the volume profile sell will actually tell you how many buyers are in that level, and the volume profile sell tells you how many sellers. Now, the most important thing is the VPD, is the volume profile delta. It's the spread difference, or the difference between the buyers and sellers. So, for example, if I have 1,907 buyers here, but I have 2,285 sellers, that's telling me that there's 378 sellers more that came in at this level, dominated the buyers in this price level, and went down a tick or up a tick, whatever, that's going on in the price. So that's kind of like the general information that I like to look at when it comes to the book. You have basically your risk and liquidity here, and then you have basically the actual bids and offers that are being conducted at that very moment. So that's kind of the general, but the one thing I really do pay attention to is the delta itself when I'm looking at a particular price level, what's going on there. This is a very good example of an iceberg order. And you ask yourself, what is an iceberg order? An iceberg order is basically, think about it this way. You have a river or ocean and you can only see the top of the iceberg, and there's a much larger structure underneath that. That's what iceberg order is on the dome. On the dome itself, you can only see, let's say for example, you only see 110 orders here. But because an iceberg order, there might be 3,000 orders actually behind that 110, but you just can't see as retail. The reason why is because market makers have the ability, the option to basically put resting liquidity orders, but hiding 90% of their size. And the reason why you ask yourself is, why do they do that? Well, one, think of it as like a game of poker. You have the ability to see other players' hands. Then if you can do that, then you can guess, well, I should fold or I should start to press them if I have a good setup, a good hand. And also not only that is you have algorithms that are programmed at the book. If algorithms see a bunch of liquidity, they're going to want to go and fuck with it. So there's a lot of different strategies that are based on that. And I'll actually get to the main strategy that I use when I trade resting liquidity. The very important thing is, and the one thing I like about Bookmap is price came down towards the low of the day. And what you start to see right here is this is what we call a iceberg indicator. So this doesn't allow me to see icebergs hidden on the book real time on the chart. This just tells me when basically an iceberg is being filled. This little indicator will actually show me exactly how much is being filled to its, Bookmap's best guess, I guess you can say. They use say MBO data, but at the end of the day, I can, use level 2 regular data and I'll work with this indicator. So, but either way, there was a massive amount of icebergs that got filled. Those were somewhere right around 5,000. Like 100, 700, and you just had a crap ton of above here. But the key thing about this is you have to understand is that iceberg orders are important, because when you see a particular absorption that takes place, if it's just a bunch of cells being absorbed by resting liquidity, that might be something a little bit different. It can reverse it potentially, or it could stall them out. There's a lot of things that can happen because algorithms are moving around in the market all the time. So if algorithms see a big absorption happen, they might actually step on the gas in the opposite direction to hit those stops. Because if you think about it, if sellers get absorbed down here and the price starts to move back up, for them to get out of their trade, they have to become buyers themselves. So that fuels to the top side. So people that program these algorithms are not stupid. They're very good at what they do. But the very important thing I wanted to point out is that the market came down here, filled with 5,000 icebergs. It did trail off a little bit, but then it started to move very much to the top side. And the question is, why is 5,000 big? Why is it important? So when you look at the delta here, the largest orders you see is 700, 600. So you kind of get the idea for the day. What's the largest size? Another 500. But then all of a sudden you see is 5,000. That's pretty freaking huge. That's very important to know. So a lot of the times is when you see the market start to rotate to the downside and it gets absorbed, a bunch of cells absorb at the bottom of the range, and it continue to go down and starts to press the upside. A lot of order flows traders will call those trap traders, and eventually they have to get squeezed out, and then market moves very to the top side. A lot of people are going to sit here and say that I don't need the iceberg orders because I can see a lot of absorptions happening in the book. That is a very good valid point, but for me, peace of mind, knowing the fact that it's iceberg orders and knowing the general volatility of the day, this is telling me that the big players are absorbing the market. This right here is just telling me sellers are being absorbed. The fact that I know that this is a big player's hand, that tells me that they have a very interest in pushing the market up for the rest of the remainder of the day, potentially. And also at the same time is there's something, if you trade with me for a very long time in different discords, is right before the market closes, literally within like a minute before it closes, there'll be 10,000 icebergs on ES get filled to the long side. So generally, if you think about it, if the prior day was long, and then the overnight session or London session is basically kind of teetering around that level and it pulls back just slightly, that's telling me the bigger players have every intention to make sure the market goes up to the top side because they filled a very large position before the end of the market. So, and all of that has to also do with margin and stuff like that. So, or it could be a general hedge position too. So I don't know. I can't say 100% everything. My best guess is, this is what's happening. This is what may happen. And there's been quite a few times if the icebergs are long, short right before the market closes, the market dumps or goes long based on that information. So that's what's kind of nice knowing in picking up these little small tricks and tips that over the years what you learn. So that's basically one thing I really want to point out in the book is absorption. What type of absorption is it? If it's icebergs, if it's just typical resting liquid absorbent, that's very important information to know just in general. And another type of trade I like to take key on the book is just actual resting liquidity. Now, a lot of people sit in there and say resting liquidity doesn't matter. But there's also another saying that resting liquidity, price has a tendency to move towards it. People use the general targets. But me personally, trading over the years, is what I've noticed is the algorithms like to push the market towards resting liquidity, reverse it, and start to slap orders right behind as the price starts to reverse to fill. Let's say there's 1900 orders right here. This is an example I saw a while back, a couple days ago. It was actually a very good one. But I did not trade it because I was just kind of chilling. But basically, price moved to it, moved towards it, moved out of it, and then 9 out of 10 times the algorithms will actually start slapping resting orders right behind it, and it'll get filled, and then it'll push into the resting liquidity, and then they'll get their position out. So it's basically they short it, rebuy back their positions, go into it, and then exit out of the liquidity. But this one was a little bit different. This was a large resting liquidity in the book, and all of a sudden the market, as status quo, reversed. I've been a good short. A lot of professional traders and good order flow traders, this is a setup that they trade. They let the market go to resting liquidity, short it, and then they'll watch it to see if it's icebergs or algorithms come in and start to lay resting orders to get their longs filled, and then they'll go long back into the trade. And that's what I love about order flow in general itself, is instead of just taking one long trade and then getting whiplash back and forth, you can literally go short, and we start to see the absorption, get out, and then if you really start to see absorption, it starts to stair step up there, and then you go long and exit out that liquidity. So that's providing you 2 trades versus your 1 that may fail. So that's kind of just in general, that's what I like. But as you see right here, market starts to move towards it, and all of a sudden it'll move away from it, and it literally came within ticks. Like literally ticks. It tested it once, 2, 3, 4 times, 5 times, 6, 7, 8, and then it finally moved off of it. So we'll start to see market moves up, a bunch of stops get hit, not a lot, but a bit. And then something interesting right here happens. As the market gets down here, you'll not only see there's 375 resting liquidity orders here, and right around here is 464 icebergs get filled right here. So that's a very big key thing to know, is that you could short it, and then if you start to see icebergs or in the dome, all of a sudden these sellers getting absorbed here. On the dome you'll see sellers getting absorbed, but on Bookmap will sit here and tell you the icebergs, hidden orders on the books getting absorbed. So that's telling me they have every intent. So there's 400, maybe a little bit more depending on if they aggressive executed market orders, 400 to 0 and stuff like that, and they have every intent to get out of that position. And then whoever here, for whatever reason, if they're in a position they're just trying to get out, or there's someone that's really interested in trying to short this market and hold this level to the downside. So there's someone's hand is being shown here, and you have to understand is this is what we call a trading event or volume event. It's understand the algorithms and big players see this, and they're going to take trades against it and then into it itself. So as an order flow trader, I wanted to start to really spot these things, these little tips and tricks, and learn how the market makers trade it, or algorithms trade it, because you think about it is they have the ability to move the market. We don't. That's a fact. And we have to be able to spot their footprints or the little foot trails in the markets and then jump on for the ride. That's all we can do, unless you start to have like $10 million, $30 million in your broker account. You have the ability to move the markets or compete with other algorithms, step over them, or other market makers, because at the end of the day, this isn't just one market maker. There could be 2 market makers trading against each other, and the question comes down to who has the bigger bankroll to squeeze the other one out. So that's a whole different level of trading. That's probably a level of trading I'll never be able to get to. I have no interest in. So, but yeah, this is pretty much it. So kind of recap is I basically went over the how do I use the profile. I use the intraday to basically see if algorithms reverse it, using targets, stuff like that, using yesterday's profile range as resistance, supports, or targets. I have the initial balance range. Basically, if we're in the middle after it's set, I want to go long or short, use those as targets, or when the market comes into and hits the initial balance, I like to short it or go long off of it, just depending if the market's rotational. But at the same time is when we dip into it, I'm looking for stops, icebergs, all kinds of things, absorption in the market itself. One other thing I really want to point it out is basically micro balance areas in the book. And what that means is you're basically looking for price where algorithms are rotating very clearly in a particular area in price. I can't figure out an example off the top of my head necessarily, but literally the algorithms, you can clearly see they're rotating the price back and forth very fast, and you're starting to see absorption and stops getting triggered, and eventually they'll take it out in that specific direction. They have a tendency to do this during lunchtime a lot because that's when the volume is very thin. And yeah, I'm not saying that this is algorithm trading, but these are those small balance areas that you can take advantage of, especially if they're hitting, this is a very good example. If you see IB, it'll literally hit IB 4 times, and that gives you 4 different attempts to scalp multiple hundreds of times. So usually in the course of 15 minutes, you could be up $1,000. Those areas. But what does this represent? Well, if you look at the dome, or the DOM itself, it's literally price moving back and forth between 2 levels. So if you want to look at the chart, if you start to see a pattern between rotation in the dome or 2 price levels, and you see an absorption on the heat map, or just absorption on the book itself between those 2 price levels, that's telling you that somebody or some algorithms moving the market between those 2 areas, and it's building balance. And so that's something you'll see on the profile itself. You'll start to see a much larger print there itself. So if that starts to happen, you can literally scalp between those 2 ranges for a very long time, or a very short period of time, and make a lot of money. But that's pretty much it. Sorry, one more thing. This may have been a good example, but what I like to do is when I start to see stair step to the top side, a lot of people, what they try to go long on the absorption to the top side. I like to actually counter trend trade these levels. So if you have a basic rotation off this, if we break straight through it and we get a bunch of stops, absorptions on the other side, I like to short these on the way up, and eventually it'll collapse to the downside. This is a little strategy that I just learned over the years, and when you look at the market just in general, it presents you these opportunities. Also at the same time is if you're wondering how can you actually trade in a downtrend or uptrend, I'm looking for balance areas, and the same thing kind of applies. So for example, right here you could see a balance area. It tested this level multiple times before it went to the downside. So this was clearly a level that was tested once and twice, then eventually down completely. This doesn't happen all the time. It's not 100%, and it literally, these algorithms will rotate it to the tick. It'll literally go up, tap it, and then just completely dump to the reverse. You're not always going to get it to the tick 100%. The opportunity is not always going to present itself. But if you just kind of pay attention to whether the range levels, the IB, you'll start to see the behavior being rotated. Instead of just saying, hey, you know what, I think this is going long, I'm going to give it a wide stop and then get triggered out, get hit out, and then I'm going to go 5 contracts and completely blow my account. So, but yeah, these are basically, just the way I learned how to view the market, how I trade it. Also, very important other thing to talk about is opening dry play. Now, opening dry play is basically hold on. So pull up NinjaTrader one more time. So when you see here, the market, usually the first 30 minutes of the open of the market, it'll actually open up one particular direction. This is a very good example. So for example, the market opened up at the open. It was a complete opening dry play to the downside, and eventually the market will, after the open, 10 New York Standard Time, it will absorb to the opposite direction. What's happening here is usually traders will try to see short, it goes short, and what they'll do is they'll go short, but what you're starting to see is a series of zigzags. Every time they go short, they get stopped out and they refuel it back to the downside. And that's how a lot of traders get wrecked during the open, because they see a move to the downside. Their account isn't large enough for the wider stops, and they'll go into it multiple times and they'll get pulled back on it, get stopped out of retracement. What they have to understand is usually what happens is the opening dry play is one direction, and they'll eventually reverse it back to the point of control, either for follow through to the downside or completely fill the initial balance gap range. But that's pretty much it. I hope that made sense. Yeah.